Okay, good afternoon, everyone. I'm Allison Jack, the Communications Officer here at the AOM Benefits Trust, and welcome to Tax Time for Midwives. So, today's presentation will support your personal 2017 tax preparations by providing information relevant specifically for self-employed midwives in Ontario, including expenses, credits and deductions, what documents you'll need, and where to find them, as well as recent changes in tax legislation that may affect you. So joining us today is Susan Morrison. Susan is a chartered public accountant and has been a member of CPA Canada and CPA Ontario since 1991. She leads her accounting practice with a team of 9 in Central Ontario, where many of her clients are midwives and midwifery practices. Welcome, Susan. So we do have all lines muted for now, but you can submit questions through the webinar system and we'll share those with Susan to answer at the end of the presentation. We can also unmute your line during the question period. If you just use the raise your hand function of the webinar system, then I'll unmute you. So then, without further ado, I will pass it over to Susan. Welcome.
Thank you, Allison. I appreciate that. So we will pass through the material quite quickly. Most of it is meant as an overview. So I'll go to this disclaimer slide. I know the AOM Benefits Trust. Allison, did you want to speak to the disclaimer piece, or do you want me to cover that?
Oh, just for everyone to know that that's our disclaimer.
Yeah.
It's also available on our website if you want to read it in full. Thanks.
Fair enough. Okay, so Allison had gone over what the main objectives are. So this slide talks about unmuting and when you have questions, so that should work well. So where I begin is to talk about Canadian tax in general, the system. So when we file personal tax returns, we are taxed on worldwide income of any individuals who are residents in Canada. It's not based on citizenship, which is very different than the system with the United States. Their system is based on citizenship, and we will address something a little later on. I've run into some midwives whose partners are US, and there are some implications for sure. So residency is a big deal. As long as you live here, work here, own property here, you're considered a resident. So if you have a rental property elsewhere in the world, or a business venture that goes beyond the borders of Canada, all of that needs to be represented on your personal tax return. Our whole system is based on around the piece of legislation called the Income Tax Act with graduated rates. I will give you a visual on what that means later in the presentation. And everything here is administered by the Canada Revenue Agency. Sure you've heard of them before. They just launched a brand new website called canada.ca. So lots of good information there. They're always trying to send out information. Our whole system is based on something called self-assessment and voluntary disclosure. What that means is you will hear lots of people saying, well, I've filed it that way for all my life, 5 years, 10 years, and I've never been questioned on it. And that is quite likely. I usually explain to clients my job is to make sure that you're educated and aware of whether it would fly if it gets looked at under scrutiny, because we can file anything and it gets processed does not mean it's been checked. It's kind of like driving without insurance. You can hop in a car and drive without insurance. It works, but you don't want to get stopped, because that's when it all comes to roost if you're claiming something that isn't according to the tax law. So the forms that you use when you file tax returns, all midwives in Ontario are considered self-employed of either their partnerships or the corporations that they're working for. So you would use one of two forms, either a 2032, it's a professional form, or the 2125, which is the self-employed form. You land in the same place. It doesn't really matter which one you grab, but those are the forms that you use on your personal tax return. What I like to explain to midwives is that the practice itself, the midwifery practice group, if it is small enough, also files a T2125. So if you are a partner in a practice group, you will have your own self-employed T2125, and you will have a partnership T2125, of which you take a piece of on your personal tax return. So The larger practices, and when I say larger practices, it means roughly revenues in of about $1 million. That's the test. The test is actually 2 million, adding your revenues and your expenses together. So you can get there quite quickly with maybe, a few partners in a practice. It's not large practice. It is 3 partner practices. You need to be looking at whether or not partnership returns are required. So then instead of filing a self-employment form for the practice group, you file a partnership return, and each of the partners gets something called a 50-13 slip for their share, and that goes on their personal return. If the practice or the midwives have incorporated, then they use a form called a T2. So those are the basic forms that you use. When we're talking about deadlines, I get lots of questions about this. When you are self-employed, as all midwives are, your actual deadline for filing your personal tax return is June 15th. And your spouse also enjoys that same later deadline of June 15th. However, that is just to determine whether or not you have a late filing penalty. If you owe tax, which virtually every midwife I deal with owes tax, they actually, CRA start counting interest as of April 30th, May 1st. So you are always better to get your returns done before April 30th so that you know what the tax balance is owing so that you can reduce the interest. We try to reduce interest as much as possible. We get lots of questions about installments. So for new registrants, someone new to practice, when you initially file a tax return, you will not be required to make installments until you have crossed over owing at least $3,000 2 years in a row. Once you're crossed that threshold, then CRA says, well, listen, we know that you're going to owe every year, so now we want a quarter of that, March, June, September, December. It's equivalent to if you were working as an employee, taxes taken off your paycheck regularly. This is just their methodology for self-employed people to say, listen, if you're going to owe, we want it ahead of time. They'll take your money anytime. You can pay them weekly if you want. But these installment dates give them license to charge interest if you don't make those installments. And the assumption is whatever I owed in tax last year is what I will owe the next year. So you make those payments accordingly. If you owe more, you have to top up. There's no extra interest. If you owe less, they'll give you refunds. That's generally how installments work. The partnership returns are due March 31st. So this really catches some of my new practice groups when they come to me and their previous tax preparers have not done the calculation to figure out whether or not they've crossed the threshold and have to file partnership returns. If they're bringing those to me in April, thinking the deadline's April 30th, if you cross by the March 31st, you're already late if you qualify and have to do the partnership piece. So it's always good. We're working with a number of practices right now, pulling together their year ends, good and early, lots of time to think about it. Corporations always have 6 months after their year end, so there's lots of time for them. The nice benefit about being incorporated is that you can actually have a March year end. That's about the only benefit for midwifery practices, and that's another whole topic. I do some presentations on the business days for the AOM, and we talk about that particular issue if you're interested in hearing more about that. So I don't generally recommend that practice groups be incorporated. I do have one slide later to discuss why one of those reasons is. T4s are all due. So for all your admin staff, anybody else who is not practicing as a midwife, they would be receiving T4s as employees, and those, of course, are due at the end of this month. So you want to make sure those get in on time. So it's a little colorful, though. This is just to get the basic concept of the difference between a deduction and a credit, because we're going to talk about how your tax gets put together, and it's important to understand the difference. Because when you're talking about RRSPs or medical credits, they're treated very differently in our system. So A is your income. So if you have slips, a T4 slip from employment, a T5 slip from investment, Say you have a rental property on the side, your 2032 is your midwifery net income. So we talk about your revenue in, subtract all of your expenses. You might have travel expenses, you might have a cell phone, you've got some other pieces or some medical pieces possibly as deductions against your self-employed income. Your net income is part of that A, income. Then we have deductions. We subtract the deductions. A minus B is your RRSPs, your child care. Also in here, moving expenses. If anyone's making support payments, spousal support payments, those are all deductions against income, and you land with C. C is your taxable income. And when we talk about what tax rate you're paying at, it is always based on that taxable income times what tax bracket do you land in. So for the purpose of this slide, I've just assumed a tax rate of 40%. I'll show you how it works on the next slide, but let's assume it's 40%. Then we subtract the credits, and all the credits are at a standard roughly 20%. So whether that is claiming a spouse as a credit, claiming your medical credits, claiming your tuition credits, there are a number of them in that category where it doesn't really matter what tax bracket you're in, they're at a standard rate. So for those, when you're talking about should my spouse take the credit or should I take the tuition transfer from our child that's in university, it doesn't really matter. It's going to count the same for you because tax bracket doesn't matter for credits. At the end, you get E, which is your tax payable. That's essentially our tax system. That is how it works. So here we go with the tax bracket. There's lots of misunderstanding around this, and I find this, I'm a visual person, so I like this little chart. It just kind of gives you, it's roughly, it is just approximate. So what this says is on the first $11,635, you will pay no tax. So if your income was below that, you pay no tax. Everyone gets that initial credit for a tax-free piece. If you're talking about your net income, so your net midwifery income plus any other sources of income, between 11 and almost 46,000 is approximately at 20%, taxed at 20%. Anything between 45 and 91 is going to be taxed roughly at 30%. Anything between 91 and 142 at 43%. Now, the misunderstanding comes when, let's say I make 95,000. Does that mean that all 95 is taxed in that tax bracket, that 43%? And that is not true. It's like a set of stairs. It's like you park that piece of income at that rate. So many times I hear the question, why would it be worth the overtime, or should I take on the extra if it's going to pop me into a different tax bracket? And that's a misunderstanding of how our system works. What happens is, if your income goes high, you will pay just on that piece that's above the threshold. You'll pay that extra tax. So if you were to work extra and go from 92 to 95, it's just that extra 3,000 that's taxed at the 43% rate. This kind of diagram helps us to understand how RRSPs work as well, because RRSPs are a deduction, if you recall, which basically comes right off of your income. So if you were going to land in the 43% tax bracket, then when you contribute to RRSPs, it will save 43% on those RRSPs. If you were only making 25,000, you were only going to save 20%. So let's give an example, $1,000 in RRSPs. If you are making 95,000, on that $1,000 into RRSPs, you're going to save $430 in tax at the bottom line. Whereas if you have somebody making 25,000, they put $1,000 into RRSPs, they're only saving $200 worth of tax. So that's how the RRSPs work. And you always think in terms of, for a couple who's in the higher tax bracket, that's who should be doing the RRSP contribution. So I'm going to move forward, but I will refer back to this particular slide and the tax brackets, because there are some implications. Certainly, the highest tax bracket over in the far right, the 202,800, is something that got brought in fairly recent, just last year. This new tax bracket is 53%, and the implications of that, if you have spouses making that and everybody pushes over that, that's a pretty high tax rate, and there are some implications to making donations and things like that. Let's move on to the next slide. Let's talk about what gets included in income anyhow. So, of course, all of your basic midwifery income is your courses of care, your backups, your experience fees, your preceptor fees, your inter-practice care fees. There are some additional pieces, and we're going to walk through that. What I like to see, and with the practice groups that we work with, we tend towards putting together a statement or a letter, a spreadsheet, a handout that says, here are all the pieces that make up your revenue. What comes specifically from, say, the AOM as fees doesn't always include all of the pieces, and sometimes a T4A. You can issue T4A. The practice group can issue a T4A, and you receive that and go, I want to know what makes up that magic number. So it's always good to have an idea. Are all of the pieces that are supposed to be there? We've taken on some new clients as practice groups and realized that not all the components have been put on the statements for the midwives to be able to claim your taxes properly. So, of course, all the basic fees, but then it's up to the practice group to figure out how they're going to allocate the caseload variables. And we've seen every version under the sun. And it's really up to the practice group. There's nothing governing that other than the partners making decisions about how that's going to get divvied up or kept within the practice. The big piece that gets missed over and over again is this 20% benefits funding. Because what happens is for the practice group, it shows a sort of in and then back out again, in and right back out. For the purpose of the individual midwife, it is supposed to be included as part of income when you go to file your personal tax return. So that's just a big piece that gets missed and is really important. If CRA came back to look at it, you don't want that hanging off the table. As far as travel compensation, so what happens, because midwives are considered self-employed out of the practice group, they are not considered employees. Technically, only employees should be getting a per kilometer rate. Everyone else, you might get paid per kilometer, but it's like a lump sum. So what happens is it's included as part of your income as a midwife, and then you claim all of your automobile expenses against it. It becomes an in and an out, basically. But it is another piece of compensation, is that automobile. And again, how that gets divvied up is really up to the practice group. There are some groups that are more rural and some that are more urban. So it might be just divided up equally amongst everyone. It might be divided up based on your caseload. It might be some other variable. So that really is up to the practice group, how that's getting divvied up. This new piece, this new equipment funding is brand new this year. And so we've been working with a number of practices on figuring this out. As of November 2017 was when the new mandate came in. In the past, a practice group would buy a piece of capital equipment, I don't know, some sort of scales or something like that, and then would submit the invoice back to the TPA for approval to get capital funding, and it was considered a grant. That has changed so that now each midwife attracts a per amount stipend. It's about $56 and change per month towards new equipment, and then the midwife themselves are responsible for paying for that. You can keep it, pay for equipment. It becomes just part of your compensation package. And the same is true, a piece is also going to the practice group to also purchase capital equipment as they see fit. There's no more of this applying and grants and back and forth. But it does change how things get reported for tax, and we'll walk through that a little bit later. There's also something fairly new. If you're doing services for physician clients, that is sort of on a per visit basis and is also being pushed out as part of your compensation package. So those are the income pieces. As far as expenses, so let's talk about this automobile piece. So what CRA is going to be looking for is a logbook. They want to know, it doesn't matter who you talk to, they are going to look for a logbook. If your particular return comes under scrutiny and they want to take a peek, there's no prescribed format, but there are lots of apps out there. So I have a number of people using the MileIQ app. That one's free, and that's Android or Apple. You can use MileBug, ACAR, Trip Miles. Look into them, see what fits for you. There's another one called AutoTrack, but you pay for that one. And so they're all fairly usable using your phones. Some people just like a calendar, a physical calendar. Some people keep track on Excel spreadsheets, notebooks, whatever works for you. What they need to see is the date I drove, how many kilometers I drove, what was the purpose of the driving, and that's basically it. So you need an accumulation of that. As a self-employed person, you are allowed to deduct the expenses associated with the vehicle based on the percentage of kilometers you've used for midwifery. So when you think about anything, if you're going to a conference, if you're going to partners meetings, if you are going to actual visits, home visits, hospital visits, anything to do with your midwifery practice, I would claim as kilometers. What these apps help you do is clock the beginning of the year, what your odometer reading was, and the end of the year. Because essentially you need to know, I drove 40,000 kilometers this year, how many were for my midwifery business? And if you have that logbook, it will tell you, oh, look at that, 20,000. So I get to write off 50% of all of my expenses, which means you need to keep all your fuel receipts, not just the ones for when you're going to a partners meeting. You can't really break down half a tank out of there and a quarter of a tank out of there. The way we do it is the percentage, 50%, 70%, based on that kilometer logbook. So you take into account your insurance for the vehicle, repairs and maintenance, loan interest if there's a loan, and we do some depreciation, or a lease if you're paying a monthly lease. And then we take into account parking or 407 fees, that sort of thing. So you keep track of all of those. Now, I do have some people that say, well, hold on, Susan, the car's not in my name. It doesn't matter. CRA does not care whose name the car is in. They just want to make sure that that car was driven for business purposes and how many kilometers, and you actually paid the expenses for them. Keep receipts. Credit card statements aren't enough if CRA comes looking. You can try and argue reasonability. I also have people come to me at this time of year and say, oh, what do I do? I didn't keep fuel receipts last year. Am I sunk for 2017? No, I would still file on a reasonable basis. Most fuel is about 10 cents a kilometer. So if you drove 20,000 kilometers in the year total, you probably spent about $2,000 in fuel. So you could still claim it. It's reasonable. I call it a filing position. It's just not ironclad. If they come looking, they might disallow it. And you can always make up your logbook after the fact. You can go back, you can sit down right now and look back at your calendar for 2017 and come up with a reasonable number of kilometers based on number of visits per client, that sort of thing. So not to belabor that, but that one we get lots of questions about. We got lots of questions about, can I use an office in my home? I have an office set up. I do lots of research on the computer. I spend time planning things. And the short answer is no. It will not stand under scrutiny. And here's why. The new test, there were some court cases 2 years ago now, And the tests have become very, very clear. The home office must be either your primary place of business, or number two, a space that's used regular and ongoing to meet clients. There was an old court case over a decade ago where a doctor got it through because the argument was, my phone appointments are, I spend in my home office, I sit in the evenings and make phone appointments. That's now been tossed based on this latent case that happened, came out a couple of years ago, that now if there's no evidence of meetings actually in that home office, then it's a clear-cut denial. They will not let you do it. It would be very, very rare that a midwife would be seeing clients in their home, unless you were maybe way up north or something like that, and that was your primary space with some office that was attached to the house or something like that. Otherwise, it's a no-go. But again, this is one of the ones where you'll bump into people who will say, we've been doing this for years, it's never been questioned. That's quite possible, but it doesn't mean it'll stand under scrutiny. So this is the new piece about equipment. So there's a line, there's a threshold, and that is $500. So if you buy a laptop, if you buy a desk, if you buy any kind of birthing equipment, your birthing bag, anything that you receive funding for and then purchase an item for more than $500, it's considered capital. And here's the problem, especially with the way the new funding is working. It is just considered monthly compensation. And what you do for tax purposes with capital items is you set them up as capital items. They've got different classes, usually class 8, which means you write off about 20% per year. It means they last you for 5 or 6 years. You're going to write that expense off over that time. It means in the year you're receiving some funding and you may not get the full write-off of what you purchased. So you'll have, this unusual little extra bit of profit in year 1, but then you'll have expenses in year 2, 3, 4, 5, where you weren't out of pocket, but you get a deduction. So it works out in the end, but it is a cash flow thing if you're buying a fair bit of capital stuff. It used to be considered grant money, and grant money just offset and you didn't set it up and depreciate, but now you will have to do that from my understanding of where the rules that CRA has in place. Some other expenses, we get questions about prepaids where you say, well, I'm going to buy a bunch of gift cards to give out to clients, and I'm going to buy that on December 31st, and that way it's an expense in 2017. And my answer is no, it's really not. That's considered prepaid. So if you pay for courses early in December for a course that you're going on in June, again, that's not an expense associated with the prior year. And your tax returns are based on what's called the accrual system, which says, so for anything I've paid for before December 31st that's actually about the following year, that's not a write-off. But anything that I paid for after December 31st that actually has to do with the prior year, I can write those off. So you pay your phone bill in January for the December bill. You're going to pay for accounting fees for help with your tax return. That counts in last year. So anything to do with that prior year. So it's just it's a cutoff thing that you watch. Another issue that gets looked at is partner loans. So you can put money into a practice depending on what the practice group policies are. They might require that every partner puts in a certain sum of money at the start of the year. That's not an expense out of pocket because those partner loans are different than actual income or expenses in or out. The other piece that I get asked about a lot is when you have a partnership and the partnership makes a profit at the end of the year, let's say a profit of $12,000, but the partners only took out $3,000. They still have to claim whatever the bottom line profit is per partner. So as a partnership group, they end up having to decide, well, how we're going to be taxed on whatever surplus there is for the partnership. And the design of the system is not that it's a big money maker. It's a little bit of compensation to help with taking the responsibility of running the practices. That's all that is. But it is taxable. So often practices will take out at least half of whatever those profits are so that it covers the tax for each of the partners because it's going right on their personal tax returns. So we can talk further. If you have questions, you can email me, but this whole concept between partner loans being separate from equity, those pieces of profit that are getting distributed, that's sometimes a brain bender for some of the new partners that I chat with, and it's an education piece for sure. So if you get under the crosshairs of CRA and you're under audit, what do I need to know? Number one, they're looking for logbooks. So before they come to visit, make sure you have a logbook. So even if you have to sit down over a weekend and recreate a logbook from 3 years ago, do it. It's just a mandatory thing. I would just absolutely insist that you at least put something together for a logbook. Keep in mind that an audit is different than what they call a desk review. So in years past, we would send all of our tax returns, paper file them with the government. They'd all get archived. And then they would just randomly choose a number of returns to just do some review. Now everything's e-filed. So the CRA reviewers don't get any of the paperwork. So now, instead of pulling out of archives, they send a letter requesting some of your documents. It might be your donation receipt, it might be a rent receipt, it might be child care receipts, it might be anything. That is a desk review, and that's very common. So don't panic when that happens. That's 1 in 5. We now know how many they're asking for, and it's roughly 20%. So 1 in 5 will get one of those letters in the summer that says, okay, now send us your fill in the blank. So don't panic when you get that. That's pretty standard stuff. Also, there is a difference. Just because you get chosen for one of those letters does not mean you've been red flagged. The majority of that is all random. Sometimes they have very specific projects that they go after, certain things, but by and large, it's random. The other piece that's really important is this, how long do I have to keep records for? And you are responsible for 6 years from the date of assessment. So if you file on time, then a regular calendar works fine for you. So you're filing your 2017 return in the spring of 2018, the clock starts. So 6 years later, which is 2024, you are able to then say, okay, now my 2017 is statute barred. We're past the 6 years from date of assessment. I can now dispose of it. Something to watch. So if you're tracking your expenses and your records using spreadsheets or whatever, you need to have access to those for that 6 year time period. It is quite conceivable 3 years from now that software has changed enough that you no longer have that software and you don't have access to it. So it's just something to keep in the back of your mind about when you're doing backups, when you're doing printed copies, something that says I will have access to everything, even if I'm scanning everything, 6 years going forward. So that just becomes a planning point for sure. Let's talk about some deductions. So these are we talked earlier about RRSPs. So you can look at what my RRSP maximums are. You do have to be careful that you don't over contribute. So you can go $2,000 beyond what your limit is, but it's pretty easy if you receive an inheritance or something and say, oh, I want to top up my RRSPs, and then you have an automatic RRSP coming out. There are severe penalties for over contributing, and it's really important to watch those because it's a 1% a month fee when you over contribute based on how much is over contributed. So that's 12% a year. It's very prohibitive. So just watch those deadlines, those maximums for sure. You can, if you received an inheritance and say you had room for 100,000, you can do that. It's probably not advantageous to take all of that as a deduction in 1 year. You can carry forward. You can choose however much you want to take and then carry forward the difference and deduct it over a period of years. So I've helped a number of people figure out what are the magic numbers on that. We talked a little bit about savings earlier when we looked at that graduated rate picture. Just an update, childcare receipts. Childcare always has to be claimed by the lowest income spouse. So every year there's 1 or 2 people that come in, they're off on mat leave, but they've continued with childcare for say an older child while they're home on mat leave with a younger child, and then they're shocked that they don't get to write that childcare off if they didn't have earned income to put it against. So that's just something to keep in mind, that it's not the highest income earning spouse that gets the child care. And the limits are there. It's $8,000 per child that's under 7, $5,000 per year for children that are between 7 and 16. So you can include some after school programs. If they will give you a child care receipt as a component, it's always worth asking. I've had people that are in karate programs and dance programs, and some private schools that have aftercare programs that they are willing to give a receipt that says this is childcare for kids all the way up to age 16, and that's a write-off as a deduction. And then if you have disabled children, absolutely the limit goes up, and there's no age limit on that. If you move, you have to be moving more than 40 kilometers closer to work. So there's a ton of write-offs, and there's a whole form. You can look up moving deductions, everything from land transfer tax, as well as actual meals and movers and selling a home, that sort of thing. Lots that you can get for moving, but one of you of a couple has to be moving at least 40 kilometers closer to your new place of work. The spousal support piece all has to do with child support is not a tax deduction, whereas spousal support is. And there's a whole ordering of operations. So if you are paying spousal support, it is a tax deduction for you. And the child support gets paid first, and whatever is left, if you short paid, it's the spousal support you short pay on. Anybody we work with, we always grab the agreement and then compare actual to what was in the agreement. So lots of areas there to stumble, but definitely it's a good write-off to remember. So as far as tax credits, so if you recall earlier, deductions are different than credits. So those deductions come right on, the deductions from the previous slide come right off your income. The tax credits are for either spouse of a couple to claim. So if you have a spouse that is making less than $11,000 or $12,000, you will be able to use their personal credit, that $11,000 you can use on your own personal tax return. Tuition for yourself or dependents, so your children can transfer to you if they don't need it. There used to be a monthly textbook and education credit piece, but that's gone as of this year. There used to be 3 different components of caregiver credits. So for prior to this year, you could claim a caregiver credit if you just had parents over 65 living under the same roof as yours. If you had them in a basement apartment or in your home in some way, that is gone. Now to claim this one new big lump sum Canada caregiver credit, it is if you are caring for a family member that is infirm. And they've removed the requirement that they be living with you. So this could be you are supporting a parent to stay in their own home or in a nursing home, retirement home. If you are helping them in some capacity with food, shelter, or with clothing, you can prove that you are helping them. They're infirm. There's an income test. Their income has to be low enough. The threshold for a single senior who's infirm is around $17,000. So if that is the case, then absolutely there's a really juicy new credit for you as an adult to help with that. Donations, this is the split strategy. If both you and your spouse are making more than $202,000, you would want to split your donations because you get 53% of whatever you donate. If you're under the 202, your best bet is to combine all donations and put them on one spouse's tax return. It's just and it doesn't matter whose name is on it. If you're in a either common law or married relationship, all of those donations can be grouped together. The same is true of medical, that all family medical receipts can be put on one tax return, and you get a bigger bang for your buck. This new piece is particularly of interest for your profession in midwifery, because if you have any clients in the past 10 years that have paid money for IVF, for any kind of reproductive technology, they are now allowing us to go back 10 years to claim those retroactively. So this is really important to think of, mine your client lists to see, is there anybody that might benefit from this? This would be a real bonus for you to pass along to your either clients or yourselves if this has been something that has cost you out of pocket money. And 10 years back to 2007, making changes on those returns. So they're really trying to make people aware of that new provision. From the AOM Benefits Trust, I was asked to put in what pieces are going to be sent out. So you will receive a slip called a T4A if you had parental leave payments in 17. You'll get the GRSP receipt for your 17 contributions. You will get your whole member information report package. Typically, that's getting sent out in March. It includes T3, which is an investment, that's interest income. It'll include your health and dental premium receipt, and that becomes really useful. Both there's a component. We compare whether it's more advantageous for you to put it on your medical credits or whether it goes directly onto your midwifery self-employment statement. And what we found last year was it became more advantageous to put it on the self-employment statement. So there's a whole method of doing that. You'll also get your supplementary fee receipt, which is, for tax purposes, we're treating those as professional dues, which we also put on the self-employed schedule. So tax changes for this year. So these are not necessarily specific to midwifery, they're just in general. So we have new in 2016 was that all real estate sales have to now be reported. New this year is that there's a form that goes with it, a T2091. You're not taxable on the sale of your principal residence. That's a whole topic unto itself. But all real estate sales must be reported on tax returns. It's really, really important. They're tracking now with the provincial registries. New in 2016 also was for teachers, that if they keep receipts for school supplies, they can get a $1,000 credit there. They do need a letter from the principal saying they are verifying it, that's all. The tax-free savings account limit is $5,500. All of those family tax cut, children's arts credits, children's fitness credits, those are all completely gone now. So those got pulled. Public transit passes are also no longer deductible as credits, except if you're a senior. If you're over 65 or know somebody who is, they get the public transit passes. So spread the word. We had an issue with diabetes last year. They said you can get a disability credit for if you have diabetes, get your doctor to fill it out. Thousands of them were sent in last year and they all got denied. And the reasoning was CRA came back and said, listen, we're not approving these unless as a diabetic person you require more than 15 hours per week managing all of this. And they said managing insulin is not going to take 14 hours a week. So it all comes down to documentation. They are revisiting it this year because there was so much pushback about that. So don't give up on it if you know somebody who has applied for this. But it's really useful to document how much time it takes you to manage it. The Healthy Homes renovation credit is still there, but it's not used a whole lot. This is for anyone over 65 that makes any renovations to their home to allow access. So it can be It can be you're fixing your stairs. It can be you're removing broadlooms so that you have smoother surface, and it's all about mobility in the home. You're moving the height of counters or changing your handles on doors, things like that. Anything that assists with mobility and keeping you in your home and you're over 65, you get a credit up to $10,000 renovation money. So that's helpful. Other changes that aren't specific to tax, but are around our whole system. The Canada Child Benefit was the new benefit started last year. It is income sensitive, so by the time you have income more than $155,000, if you have one child, you no longer get it. So it's all based on number of children, how much income you have, and it is not taxable all when you receive that. So there's some strategy if you are separating or divorced about who's getting it and how you're splitting it, and who has custody and all of that. But otherwise, it's fairly straightforward. New this year is that the EI is being amended. When you're on parental leave in the past, you would receive benefits over 12 months. You can now extend that to 18 months. You don't get more money. They just stretch the money from 12 to 18 months. But it is an option to stretch it over the 18 months. And in the past, you could only start taking it up to 8 weeks before the expected birth date. Now it can start up to 12 weeks earlier. So you're really just shifting it. It's the same amount of money. It's just giving taxpayers an option of how they want to pull it. That's what's changed. CPP is going under major overhaul. As self-employed midwives, you are paying CPP on your tax return on your self-employment earnings, and they are raising, and right now it's about $2,400 is the maximum you would contribute. That is going to be going up $150 every year from 2019 to 2025. It means you'll be entitled to collect more at the back end, but it's just something to be aware of. If you're way behind on your taxes, you can go in the back door through something called voluntary disclosure. All those rules are tightening. Just a point about CRA fraud. CRA will never, ever, ever ask you to e-transfer them money. They will never, they don't email. So you won't get an email from CRA ever. It's a scam. If they send you something, oh, you are entitled to $513 and just click here, and that it's all fraudulent. If you ever get a phone call from CRA asking you for something, you can always just say either call my accountant, because they have that on file and you don't have to say another word, or just simply tell them, please send it to me in writing. They are always required to send something to you in writing. There have been some scams where they've required people to go out and get, thousands of dollars of Visa cards or gift cards, and it's all just fraud and scam. They don't ever ask you to pay in gift cards. There are significant changes with the IRS in the States. So if anyone's a U.S. citizen, they have to file, even if they've never even been to the States. If their parents were both U.S. citizens, that means you are a U.S. citizen. You will need to file a U.S. tax return. I won't go further into that. That's another whole area. Bitcoins is another whole area. I have clients that are into it, and it is taxable. So it's either taxable with capital gains or as business income. And if you have anyone that wants a discussion about that, we can. It is treated like a commodity, really, for CRA's purposes. They already have rules out about it. It's not gambling. It's not tax-free. Points programs, CRA is looking at, do you have personal benefit of a company credit card point system? So if your midwifery practice has credit cards and there's points being earned, and you as a partner are using those points personally, it's considered a benefit, and they are saying they're doing a project and they're going after that as income. Crazy as that is. So this is just a very quick slide. This is rare, but if your practice, which is the green triangle, is made up of all of the midwives that have incorporated, there is a serious downside to this structure. I don't think very many of you are in this structure, but if you are, contact your accountant, because Section 55 is very problematic for this structure. That's all I'm going to say about this, because yeah, this is just a little more in depth, but just if you are part of a structure like this, get help right away. So we're at the end. Big picture, bottom line, be aware. If you call CRA and on one of the phone lines and they give you some advice about how to file your tax return, there have now been a number of court cases where there is proof that CRA's employees gave direction to someone filing their tax return, and the court decided that those CRA employees were wrong, and too bad, so sad, the taxpayer pays the price. So that's just something to be aware of. Get your advice in the right place, somebody who can advocate for you. If you are interested, I do a mail out every year to all of my personal tax clients with a comprehensive list of deductions and credits. Email us. The email, if you look in the top right corner of all of these slides, is our website. You can email me at smorrison@morrisoncpa.ca. If you want that checklist, we will send that out to you. No problem. And Allison, we're right on time. It's 12:50, so we will open it up if there are any